We're seeing the dollar rising this morning on the back of that hotter than expected CPI print, up a little over, it's looking like 0.8% here. But our next guest saying that the doubts for rate cuts combined with political risks could suggest that the stronger for longer dollar could remain. We're going to bring in Jane Foley, head of FX strategy at Rabobank, to discuss. Jane, thank you so much for being here. To what extent do you anticipate this stronger for longer dollar having legs here, given some of the risks that we see out there geopolitically with the election? How long could this last?
I think this could last for quite some time. I mean, if we look at the US economy, it's certainly a lot more resilient than other major economies. I'm focusing here particularly on Europe, but certainly if we look at China, if we look around the world, we see a lot of weakness elsewhere. And so you have this point of time where the market consensus is quite strongly in favor of an ECB interest rate cut in June, whereas every week it seems that more data from the US is chasing away at the possibility of a spring or even a summer rate cut from the Federal Reserve. So that in itself, interest rate differentials is favoring the dollar. But as you mentioned it, there are geopolitical concerns. They have had an impact on market pricing, certainly last week. Certainly if you look at what was happening to gold, oil last week, they could come back. They could create some safe haven bid for the dollar too. But also, if you look after the US election, particularly if we had, for instance, a Trump presidency, if he were to introduce those tariffs that he's warned about, well, that could be inflationary for the US too, putting tariffs on the prices of various different goods. And that could mean that the US's or the Fed's easing cycle could really be quite short-lived compared with some other countries. And that too could sustain the dollar being stronger for longer.
Short-lived, Jane, what you were just talking about with the easing cycle, what more specifically do you think we could potentially see?
Well, I mean, clearly that's going to very much depend on the data. The Fed have made it very clear for quite some time that they are data dependent, and they still are. But I think what they were hoping for in today's US CPI report was perhaps some evidence that the stronger inflationary impulses that we've been seeing over the last couple of months, perhaps they were just bumps in the road. And in fact, the fact that we got a stronger number today means that maybe these aren't bumps in the road. Maybe inflation is just much more stickier than they hoped it would be. Now, before the summer, we will, of course, have more US data. But even if we look to that payrolls report that we had at the end of last week, if we look at that earnings number, 4.1% year on year, well, that's not particularly conducive to a 2% inflation target. So it is quite difficult to put the arguments together now to suggest that the Fed should be cutting 3 times this year. Those arguments are looking, quite flaky right now. We really would have to see some concerted weakness in all of the other US inflation indicators between now and the summer for the Fed or the market to be confident that they can really go 3 times this year.
Jane, I'm looking for evidence in this market that we're seeing a repricing of November for the potential first go at the Fed cutting rates. Within the FX space, what would you be looking at to indicate that the market is pricing in November as the first cut?
Well, of course, first and foremost, we must look at the economic data, and there's an awful lot of figures between now and November. In fact, there's a lot of data between now and September, which could, push us in either direction. But clearly the market is taking on board that the risk that this resilience of the economy, the resilience of or the stickiness of inflation could continue. But as we get to November, well, we do have the election there, and that's politically difficult for the Federal Reserve. They won't want to be seen as being politically motivated. That could impact their credibility. So November is a difficult time. So possibly, you could make an argument that if they can't cut by September, if the economic data isn't weak enough by September, well, maybe they won't be able to go until after the election. Now, that is not a consensus view right now, but it is out there. It is beginning to be discussed.
Do you think the odds of that are more likely on the heels of this print, clearly?
Yeah, the odds have certainly increased of that on the heels of this print, but it is right now still only April. We are generally still looking at March data, so we have a lot to digest between now and the summer. But certainly that the odds of that have now increased.
Jane, talking about the implications of the stronger dollar, some of the critical levels that you are specifically watching when it comes to that trend that we've seen upside to the dollar, what are they? And talk to us, for our viewers, for our investors out there, about why it's so critical, obviously, that they do pay close attention to the price of the US dollar and the implication here for multinational companies.
Well, that's a very interesting question and can be answered in several different ways. But what I would say is, for instance, if you look at the European Central Bank, the European Central Bank will not be as worried about the relative weakness of the euro today in the same way that it may have been 6 months or 18 months ago. And that's because inflation is far more under control in Europe now. Now, a weaker currency is clearly an inflationary impetus. It brings that with it because it brings in higher import prices. But if you're looking at inflation being much lower, if you're looking at economic weakness, like the ECB, certainly is when it looks at Germany, well, the weaker currency will not be so much of a risk to its policies. And that's why the market consensus is still very much in favor of a June interest rate cut from the ECB. Now, clearly, if the dollar carries on strengthening, if euro dollar, goes down more this year, to 105 or even lower, well, yeah, that may have an impact on the pace of interest rate cuts, but it's not the threat. The currency weakness is not the threat that it would have been a while ago. That said, if we look at dollar yen, it's at 152. The market is very frightened that will bring in some FX intervention from the Ministry of Finance. And certainly, I think between these sorts of levels at 152 and 155, the risk of intervention just to stabilize that currency, to keep the yen from weakening too much, does have to be considered. There is a very strong risk that the Ministry of Finance will intervene to try and prop up the yen.
Well, and it's a great point that Shauna brought up about kind of the spillover effect of economic data like this in the U.S. globally. Since you mentioned the dollar yen, I want to talk about the yen breaking through that 152 level. And you mentioned this as well. How likely do you think it is the Japanese authorities are going to want to intervene now that we've broken through that key level?
Well, I don't think they would ever have gone immediately after that level. They're understanding that the market was very much focused on that level because that's when they've intervened before. But, I think between 152 and 155, that the risk does go up. But FX intervention is not without cost for a monetary authority. And the cost could come both in financial, but also in terms of credibility if the intervention fails to turn a currency pair around. And so I think what the Ministry of Finance the Bank of Japan will be waiting for is hopefully some stronger economic data from Japan, maybe from the April 26th Bank of Japan meeting, maybe a little bit more hawkish commentary, because if that happens, the ideal situation for the Ministry of Finance is that will help stabilize the yen. They will not have to dip their toe in with any more than verbal intervention. So the next few weeks, I think, are going to be really critical for the Japanese authorities.
All right, Jane Foley, appreciate you hopping on with us here this morning, head of FX strategy at Rabobank. Thanks so much.